Hi, everyone. Thank you for joining us for today's webcast, Gold in the New Financial Landscape, sponsored by Sprott Asset Management. Today's webcast will be providing one CFP, one CMA, and one CFA CE credits. If you have any questions on credit, please don't hesitate to give us a call at 704-540-2657. We welcome any questions you may have at any point in time during today's webcast. You can type your questions in the Q&A box to the right of the slides, and we'll do our best to get to as many of your questions as possible. In the event your question is not answered during today's event, a member of the Sprott Asset Management team will get back to you directly. We have made materials available for you to download in the Documents folder at the bottom of your screen. As always, we appreciate your feedback and are striving to make these events the best they can be for your viewing satisfaction. At your convenience, please take a moment to take our survey that is also located at the bottom of your console. We will cover quite a bit of information during today's webcast. If at any point in time you are interested in scheduling a one-on-one meeting with Sprott Asset Management, please click the one-on-one folder at the bottom of your screen and confirm the request. In the event you missed any part of today's webcast or simply would like to watch it again, a replay will be made available and all registrants will receive that information by email. I'd like to introduce today's first speaker. Ed Coyne joined Sprott in January 2016 and has more than 25 years of investment management and sales experience. Previously, he was a principal and investment specialist for 18 years at Royce & Associates, a small cap value manager located in New York City. So Ed, take it away.
Thank you, Natalie, and thank you all for taking the time out of your schedule today to join us. Everyone at Sprott, wishes all best wishes going forward, and we all believe that brighter days are ahead. So again, thank you for joining us today. We're also fortunate to have both John Hathaway and Whitney George on the call today to talk about both gold and gold equities. John Hathaway is a CFA and senior portfolio manager at Sprott Asset Management. John joined Sprott Asset Management in January of 2020 as a portfolio manager of the Sprott Hathaway Special Situation Strategy and co-portfolio manager of the Sprott Gold Equity Fund. Previously, John joined Tocqueville Asset Management, LP, in 1997, where he was a co-portfolio manager of the Tocqueville Gold Fund, as well as other investment vehicles at Tocqueville. John earned his BA from Harvard College and his MBA from the University of Virginia and holds a CFA designation. Also with me today is Whitney George, our Chief Investment Officer of Sprott Asset Management and President of Sprott, Inc. Whitney George serves as the President of Sprott, Inc. and Chief Investment Officer of Sprott Asset Management, LP, as well as the Chairman of Sprott U.S. Holdings. He is also a Senior Portfolio Manager at Sprott Asset Management, USA, and Whitney joined Sprott in 2015 and was previously spent over 23 years in senior roles at Royce & Associates in New York, where he was a co-chief investment officer as well as portfolio manager on multiple funds. Whitney holds his bachelor degree from Trinity College. At this time, I'd like to turn it over to Whitney to go into the gold equity market.
Thank you, Ed. Ed mentioned that I spent 23 years at Royce and got a half a title as co-chief investment officer, and now that I work for a gold mining company, I have about 15, so I'm sorry about all that noise. But good afternoon and good morning on the West Coast. Thank you for joining us. I hope everyone's safe and doing well. The one happy thing going on today is you're listening to this webcast rather than filing your income taxes. So certainly some things have really changed. I first want to tell you a little bit about Sprott. We're a global leader in precious metals investing. It's pretty much all we do. I joined the firm a little over 5 years ago, having been and still a long-term value investor, generally with an optimistic view of the future, but an awareness of leverage that was building up in the global system. I have been a personal investor in physical gold and silver since about 2000, and have been very fortunate to be joined by Ed and Heather McLeod in marketing, Royce veterans, as well as John Hathaway recently, who really put the finishing touches on our organization. We're a publicly traded company listed on the Toronto Stock Exchange. We are one of the largest precious metals focused managers, or I'd like to think of ourselves as alternative asset managers, gold being kind of the original alternative asset. And I'd say we have that position globally. Our assets are roughly $10.6 billion at the end of the quarter, a little bit better since then. But more importantly, we have a very, very deep bench that covers of professionals that cover all aspects of the gold trade, from our physical trusts that invest in allocated metals held at the Royal Canadian Mint, to our now enhanced and larger equity management business, thanks to the addition of John Hathaway and his team this January. And we have been, for over 10 years, a leading structured finance provider, providing private loans to very large institutions in the mining sector. It's a special niche, but this allows us to view all parts of the capital structure of mining companies, and we follow them from the very early days of exploration right through to the largest mature precious metal miners. We serve not only institutional clients, we have retail investors in our mutual funds and our trusts, investment advisors, family offices, and we offer both open and closed-end funds, SMAs, and partnerships for some specialized ideas. On the next slide, the case for gold and gold equities, which is what we're here to talk about today. We think we're in the very early innings of a renewed bull market in gold. We think this bull market has been going on with a punctuation from 2011 until 2016, but has clearly resumed and, if anything, been reinforced and accelerated by the recent crisis of COVID-19. I think what has happened is a lot of the long-term concerns and issues that were building up globally with debt structures have suddenly been pulled forward and have become very near-term realities. And we believe that has changed fundamentally the investment landscape for some time to come. Gold is one of the few asset classes that offers both some downside protection during turmoil, but without giving up much on the way of the upside performance when things are going well. Gold can go up at the same time equities, and we'll get to that in just a bit. The global response to the pandemic has been unprecedented in terms of economic stimulus. We are into QE4 or QE infinity. There's been $2 trillion plus of fiscal responses. Basically, the bankers learned their lessons in the financial crisis of 08 and 09 and are quickly and massively applying the solutions that they took so long to learn during the last downturn. We think the trend in the global interest rates will continue to be lower, i.e. zero currently at the short end, with a strong likelihood that longer-term maturities start to be fixed near zero in order to finance all of the stimulus that has already been announced and is probably yet to come. As terms of gold equities, gold mining stocks typically in prior cycles have outperformed the underlying metal by 3 to 5 times. It can be a very dynamic group. Currently, near-term suspensions and government mandates have reduced activity in the mining industry, which have added a short-term supply issue that is being met by increased demand. We think miners with strong balance sheets and quality reserves are best positioned to enjoy higher profit margins when the price of the product they produce is going up and their costs of producing it, principally oil and labor in foreign jurisdictions, are going down. This is an industry that can produce pharmaceutical-like margins. Also, at this stage, it seems hard to find another industry that is likely to have rising profits and expanding margins and accompanied with EPS growth in the next few years. On top of that, the M&A cycle continues to be robust in the industry. This is not an industry where you can invent a new product. You must go out and discover it and develop it. And the life cycle of doing that is at least 10 years. If you have underinvested, your only option is to go acquire. And as John will tell you in a bit, the dynamics within the industry and the valuation discrepancies between the largest companies and everyone else is created a very, very good period, we think, or a very good opportunity for M&A. On the next slide, this is a chart going back to 2000 showing gold's performance versus bonds, the S&P 500, and the dollar. As you can see, the record stands for itself. I think this is a reasonably relevant time frame. One could go back farther, but starting in the very late 90s, we began under Greenspan this kind of modern central bank could try and manage the economy and manage to respond rapidly to any kind of crisis. We have been attempting to defer any kind of future recessions through monetary policy, which has obviously created this, the current situation. More debt, more support from central banks, more money printing. Gold is a great alternative asset in anyone's portfolio. There are a lot of studies, and we'll get to it, that suggest that adding gold to a traditional 60-40 mix enhances performance. 10% can enhance performance by 50 basis points a year over very long periods of time. It is not correlated to stocks or bonds or commodities. The chart here shows how various asset classes correlate. What's interesting is that gold has a negative correlation to the S&P 500 during contractions, but a zero correlation during expansions, which means that you don't have to pay for this insurance. It can go up when life is good. The next slide gives you some recent crises and how gold performed. Currently, in our current state, gold's up about 13% as of, I think this is as of very recently, the 13th, 2 days ago. That compares to bonds up 8% and equities down 13%. So it's doing its job, and what some of us, or those of us at Sprott, expected it to do. And then the final slide for me is how gold has performed year to date, up 13%, and everybody else kind of knows how the other asset classes are doing. This is not to say that gold can't go down. During high stress moments, liquidity crunches like we experienced last month and like we experienced in the fall of 2008, people sometimes need to sell whatever it is that they have that's liquid, and gold will be included in that basket. But once liquidity is provided or restored, it very quickly recovers. People who buy insurance occasionally need to make a claim, but once that claim is paid, they can go back and reestablish their policy or continue to pay on their policy. And I think that's the way to think about it. I know the media spoke a lot about how gold wasn't working as a hedge. It was going down like everything else. That was a very short-lived experience. Everything that we're seeing right now looks very much like the 2008-09 period, only what took weeks then takes days now. And I think it's a good model looking forward. Gold turned around in October, third week in October of 2008, and then proceeded to hit new highs. Gold equities rebounded shortly after January of 2009, and the rest of the world did not turn around and reverse course to the upside until March of 2009, at which point gold was hitting all-time highs. So with that, I'd like to turn it over to my partner, John Hathaway, to talk a little bit about what's behind the current situation, both fiscal and gold equities, which is where he is the real specialist. Thank you.
Okay, Whitney, thanks. And let me just say briefly that I'm just delighted to be part of Sprott. I think we have the ability to create the dream team in the equity space. We're combining research capability. We're attracting new people. And I would suggest that in terms of active management, we will be the top name in the space in short order. So with that, let me just address the slide here. And what comes across to me is that we can see what central banks are doing. But what stands out to me is that in 2009, the combined balance sheets of the European and U.S. central bank were around $5 trillion. At that time, gold traded at an all-time high of $1,900. And here we are today with the combined balance sheets at $12 trillion, and gold is $200 lower than it was back in 2011. And what that says to me is that gold and then gold stocks are way behind where they should be. I would suggest that here we are at a pivotal moment in all financial markets, and for gold in particular. The landscape is, I think, forever changed. COVID-19 might be getting all the headlines, but in my mind, it was simply the pin that burst the bubble of credit that supported financial asset valuations. So let me take you through the rest of the slides here and suggest as to why I think it's still early days in this next leg of the gold bull market. The previous chart addressed the fact that monetary policy, and there's no better word for it, is going ballistic. I understand the need, the urgency, the response. I'm not being critical of it, but it's a fact. The implications of what central banks are doing are extremely positive for gold and related mining stocks. One thing that comes to mind is that that bonds, to me, are the losers in all of this. You can certainly suggest that risk parity, which is very popular, is a failing trade. We see that the liquidity injections that we saw on the earlier slide, that the bond market has become socialized. You might as well say that the Treasury and the Fed have merged. So it's hard for me to see a lot of upside in owning Treasury bonds, and there's perhaps some risk. I would say that the possibility of inflation is around the corner. Timing is always an uncertain process, but it seems to me that if one had a heavy exposure to bonds, worries about inflation would be very appropriate. On the other hand, and I know there are a lot of great arguments to the contrary, that where we sit today in this credit crisis and frankly a collapse in credit, that we could be in a long-term deflationary environment. And there are strong arguments either way. But either way, gold is really the antidote to this dilemma. So let's go to the next slide. More on bonds. Credit deflation is clearly bad for fixed income, and the junk market has sneezed, but the rest of the market is catching cold. Credit downgrades in February by agencies were roughly around 80. In April, this is as of April 9th, it was 1,044. Junk is 25% of the $9.6 trillion corporate bond market, but pre-junks, bonds that are just slightly above junk status, is about 40%. So and further down, rating agencies are notoriously slow to adjust to reality. So my guess is that more bodies will be floating to the surface in months to come in the bond market. And one of the conclusions from this is that despite all the stimulus, monetary and fiscal, that the economy is going to continue to limp along. Of course, we'll have a recovery from the shutdown and from all the stimulus. But my expectation would be that that recovery will be very, very weak and subpar, and perhaps quite subpar relative to expectations of equity investors. So let's go to the next slide, where I'd like to address where gold mining stocks could be positioned in a strategy that is in sync with this overview that we're presenting. As Whitney said earlier, gold stocks performed substantially better than the metal price in previous bull phases for gold. The 1970s would be a good example, and then I would say the entire first decade of this century plus a few years would be another example. So I would suggest that first of all, gold is mispriced in my mind. It should be substantially higher. The previous high of $1,900, we're trading at roughly 10% below that, with tremendous macroeconomic changes that have taken place. So the gold price is behind where it ought to be, and in my mind, it should trade, I think, in the years ahead, substantially above the previous high of $1,900. That would suggest that mining stocks have enormous catch-up potential, and in terms of an aggressive and maybe a little more risk-tolerant approach, but in sync with this macro view, they would be an ideal way to participate and to add positive return to any investment strategy. One of the concerns right now is that mine shutdowns would be perhaps putting pressure on profits and cash flow for the mining industry. But for the most part, and I think the number is something like 190 mines around the world have been in some way or another been impaired currently by health-related concerns. But that metal is still in the ground, and it will be produced very likely at higher prices. So we're beginning to see the mining stocks look past the current hiatus in production. And for the most part, miners have very good balance sheets. Their cash generation is extraordinarily strong. And so while some mines are shut down, other mines are operating, and they don't have a lot of debt. So we expect that the companies will survive the shutdown far better than many other economic sectors. I would just lastly address the issue of M&A. One of the things that we have noticed over the last several years is that the mining industry, because we've been in this penalty box for the gold price and mining stocks for the past 7 or 8 years, the industry has not been expanding. So the reserve life of the industry is the shortest it's been in 30 years. And therefore, we expect to see a wave of M&A activity, which goes to our strategy of investing in mid to smaller cap stocks that could be takeover candidates. In any event, this is an opportunity-rich environment. And despite the fact that gold stocks on a year-to-date basis are roughly flat versus January, there have been outflows from the sector. I look at the VanEck GDX ETF that I'm sure you're all aware of, and they've actually seen outflows on a year-to-date basis. Our flows have been positive, but my conclusion from this is that mining stocks, gold is underowned, and mining stocks are even more underowned. So let's go to the next slide, please. And this addresses what I just talked about, which is how cheap gold stocks are today, not only on an absolute basis, but also relative to where they've traded historically. It is not hard to find companies with free cash flow yields of 12 to 20%, trading at enterprise value to EBITDA of 3 to 5 times. These would typically be more in the mid to smaller cap areas, but you would also find extraordinary value in some of the larger cap companies. So again, I think it's a target-rich environment. I think the timing is now. I think we are in the midst of an upgrade for gold and precious metal stocks that is happening before our eyes, and it's due to the macro environment that both Whitney and I have described. So with that, let's go to the next slide, just to recap what I've been saying. It's one of the few places in today's world that you can both protect capital and absolutely, and in addition to that, look to the possibility of positive returns. Even though gold has performed well over the last 20 years, which a lot of people don't would surprise them, and then over the last 3 months, there's tremendous upside ahead. I think we're just beginning this next phase. I also believe that we're at the end game for traditional policy applications to the credit crisis that we're in. There's a factor of diminishing returns for the application of ever more layers of debt. The world is already over indebted, and when we come out of this, which I'm sure we will, we'll be even more indebted, and that will be even more of a damper on economic activity going forward. So again, thanks for listening, and let me turn it back to Ed for Q&A.
Thank you, John. And before we go into the Q&A, I think there's a few things that are worth pointing out. One of the biggest questions we typically get is, if I'm going to allocate to gold, what should that allocation look like? And we did a lot of research on the actual output of a gold allocation and what that actually means for a portfolio. And we've always found that physical should be allocated to first and should be allocated to as a core part of your portfolio. And then based off the directional price of physical, as John and Whitney both alluded to, then you can enhance that allocation with a combination of both physical and equity, gold equities, as a more tactical, opportunistic allocation to round out your full allocation. But on the pure physical side, anywhere between 5 and 10% in gold has enhanced returns, and more importantly, it's actually reduced volatility relative to a 60-40 portfolio. In fact, you looked at a 50-40-10 portfolio of 50% traditional stocks, 40% bonds, and 10% physical gold. That portfolio not only outperformed a 60-40 portfolio by over 50 basis points per year, it has done so for the last 2+ decades. So I think this is something that's worth pointing out. As more and more investors look to allocate to more alternative strategies as a way to buffer not only their equity portfolios, but look for replacements to their bonds and maybe even look at ways to enhance their cash positions in their portfolio, a core allocation to gold right now, in our view, makes a lot of sense. And in addition to that, we think the equity story is looking more and more attractive when you compare it to the directional price of gold. And from a product standpoint, Sprott actually offers a full suite of solutions. As Whitney said, we've got a long track record of focusing on gold, silver, platinum, palladium, precious metals in general, as well as real assets. And at Sprott, we offer a full range of solutions that give you exposure to really all three of those types of disciplines. On the physical side, Sprott offers ways to allocate directly to physical gold that allows you to have direct ownership in a very liquid, potential tax advantage way for U.S. investors. For clients that like the silver trade, we also offer a trust that allows you to allocate directly to silver. For those that can't decide between one versus the other, we have a physical gold and silver trust that gives you a combination of both. And then lastly, we offer a platinum and palladium trust that gives you exposure to both platinum and palladium. In addition to our physical suite of offerings, we have a full suite of equity solutions. As John had mentioned, we have the active mutual fund, the Sprott Gold Equity Fund with the ticker symbol SGDLX, which invests in both gold stocks across the market cap spectrum and can hold up to 20% in physical gold to help dampen volatility. It tends to be more in the mid to smaller cap range and what we think are the higher quality, better balance sheet, better operator range, which we think over multiple market cycles really add true value to the gold equity space. In addition, we have two passive vehicles that are really smart beta approaches to the gold equity market, which give you exposure to either senior large cap gold miners that typically have multiple properties, multiple locations, and that's got the ticker symbol SGDM, as well as junior mining ETFs that tend to be more single line properties and unique properties that we think will actually be enhanced through the M&A cycle that John had also mentioned. We also, to Whitney's point, offer a full suite of institutional offerings from the equity side to the credit and debt side. So at Sprott, what I would encourage those on the call to do is to really, based on where you are in the country, take a moment to reach out to our senior investment consultants. They are very well versed, and our firm is a very flat organization in that we all have access from the CEO down to all the senior portfolio managers. So I would encourage you to reach out to your local senior investment consultant at Sprott. We've provided both the direct dial-in numbers and email addresses on this page. You can also call me directly at any time, and we would love to work with you and consult you and advise you on how to think about both the gold and the gold equity trade as we go into the sort of the new frontier of the modern market. Now, before I turn it back to Natalie for Q&A, I did want to actually highlight one final page, and John had already made mention to this, but I think the depth and breadth of our overall gold team is quite impressive. We are not only focused on a single asset with over 3 decades of experience and well north of $10 billion in assets, but we have a large bench of very senior investment specialists on the equity side, on the trading side, and on the management side. So John, just any final comments, now that you're really part of the Sprott family, any final comments you would like to leave all the listeners with today on really what's special about Sprott and our full team of gold investors?
Sure. When I look at this slide, we have tremendous depth, ability to research investment ideas, stay in touch with managements, and actually, in many cases, affect outcomes of financings. We're as close to being activists as we can. We are definitely very vocal backseat drivers to all managements where we have an investment stake, and so it's something that I had aspired to in my 20-plus years at Tocqueville to do, but never really had the depth of resources in terms of experience, skill sets, and so forth to do it on my own. But now we have that ability, so I think we will be able to, in many cases, affect positive outcomes for investors in specific stocks that we're committed to. So again, I think for me, I'm only a couple months into it, but we speak every day on the phone. We have a research meeting every morning, and there's a lot of cross-fertilization of investment ideas. So I think it's a very powerful combination for active management in the equity space.
thank you, John. I do think those are all really important points to point out to all listeners today. So again, please, think of us as your advisor or consultant to both the gold and gold equity space. And with that, we've got some time still to answer the many questions that have come in. So at this point, I'd like to turn it back to Natalie to go through some of the top questions we've been receiving.
Great. And thank you all so much for such an informative presentation. I want to remind everyone that a copy of today's presentation as well as additional material can be found in the Documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey, also located at the bottom of your screen. Our speakers will be taking advisor questions. Please type your question in the box to the right of the slides, and we'll get to as many of your questions as possible. In the event your question is not answered on today's webcast, a member of the Sprott Asset Management team will reach out to you directly. And if you'd like to have a conversation to further discuss the ideas that were covered during today's event, please click the one-on-one folder at the bottom of the screen and confirm the request. So with that, let's go ahead and take our first question. So the first question reads, outlook for exploration companies. So over the next 5 to 7 years, do you think it will be best for investors to own physical gold or major mining companies, royalty portfolios, exploration?
Okay, I guess I'll take that. There are all stripes and variations within the gold mining space. And in our main gold fund, we're focused basically on individual company quality. We do deep research on management teams, assets, balance sheets, income statements, and all of that. And so I frankly would say a diversified approach, which is what we do, makes the most sense. There are pros and cons to smaller exploration companies, but one of the cons is that they're less liquid and have not captured a lot of flows just because ETFs, which are very dominant in the space, can't invest in them. They just don't make a difference. So I do think at the end of the day, if one is patient, they can provide spectacular returns. But in the near term, I think you have to deal with lack of liquidity and the fact that they may just sit out the early part of this cycle. And I'd be happy to go into more depth on a one-on-one basis as to the various pros and cons of the other categories that were mentioned, but I'd like to get to as many questions as we can.
Absolutely. Thank you. So the next question reads, please differentiate the merits and risks of investing in funds and ETFs that buy actual physical gold compared with funds and ETFs that buy gold miners, and which do you invest in?
So this is Whitney. Again, we think of gold or gold-related products, which would be the gold ETFs, as sort of a core evergreen allocation that has both defensive and some offensive characteristics, but stocks or ETFs that own the underlying miners as having a lot more upside potential under the right circumstances with a lot more volatility. So for us, we think of them as more tactical in terms of what you want to own in your portfolio. I sleep very well at night through all cycles owning some physical gold, and there are times when owning the stocks or ETFs are rewarding, but it does not come without volatility from time to time, as we've experienced in the last 5 or 6 years.
Great, thank you. An advisor would like someone to please review how gold bullion can be owned tax efficiently. So
our trusts are ETF-like, that are physical claims on ownership of gold stored at the Royal Canadian Mint. And because they're trusts, not ETFs, they're taxed like stocks, i.e., can qualify for long-term capital gains as opposed to collectible tax, which is kind of what ETFs give you because they're passing through the underlying asset tax rate. And this makes them, I think, better for portfolio rebalancing. You're trading a like tax situation for another one, over time. In the short run, obviously, if you're after short-term gains, it's not going to make a difference.
And how is your gold fund supported by actual gold holdings? So what is the underlying asset? Is it like Fort Knox where we all believe there's a gold there but no one knows?
I should hope not.
These are the trusts. The gold is stored at the Royal Canadian Mint, and we pay regular visits. They're very good friends of ours. The Royal Canadian
and the gold
Crown Corp. Sorry, John.
I was just going to say that the gold in the gold fund is stored at Brinks, which is a logistics and transportation company. It is not in the hands of a bank which could rehypothecate and leverage off of our allocated gold position. So for the Sprott Gold Fund, Sprott Equity Gold Fund, the holding is very safe.
Great, thank you. The next question, how much of an impact has COVID-19 had and is anticipated to have on mines in terms of closings and delays, and do you prefer the senior or junior miners overall right now?
I gave a number earlier. I don't know what the aggregate reduction in gold mine supply is as a result of this, but every country has a different set of regulations. Mexico has shut down completely for about a month, and every country is a different story. But as I said earlier, the mining companies are generating, even with these shutdowns, good cash flow. Balance sheets are at least the ones we're invested in, are strong. And so while it is a concern, I don't think, compared to other industries like airlines or restaurants or leisure, that sort of thing, the gold mining industry is in very good shape.
Yeah, to add to that point, I mean, the revenues and profits from the gold mining industry are only delayed, for some period of time. They're not lost forever, as they might be in some of the industries that John mentioned.
Great, thank you. And an advisor said, I have heard that there is a limited supply of physical gold, which would cause issues if investors called for physical delivery on futures contracts. I've also heard that China is buying up the majority of the annual production of physical gold. So could you speak to those two issues as either fact or fiction?
You want me to try that, John?
Yeah, go ahead.
There are supply disruptions in the physical market. For instance, the silver has become very difficult to obtain. Silver coins are now trading at $25 an ounce versus a spot market of $15.5. In part, that's due to the reduced demand over the last few years. So the mints and dealers were not prepared for the upsurge in demand, and we're quickly out of supply. The mints and refiners have had to use social distancing, so they're making the larger denominations that don't require densely populated factories. And Switzerland shut down its refiners for a while. I believe they're opening up. So I think a lot of this is temporary. There's plenty of metal around. It just doesn't happen to be in the right places all the time. A lot's in London and is typically transported over on airlines in the baggage department with limits as to how much can be shipped at one time by the insurance companies. That has to now come by ship. So that takes longer. So I think you're seeing a lot of angst about supply. It seems to me those are shorter term issues. They have been reflected in the futures contracts trading at $40, $50 premiums to the spot price of gold, but those future contracts usually get rolled forward. So what was looking like a problem, for April or March is, now kind of been rolled forward to June. Again, we think it's a timing issue and not a main feature or investment thesis in the case for gold.
Thank you. An advisor would like you to speak to the issue of investing in mutual funds and/or ETFs versus direct holding of gold. So does this relatively low percentage held in gold today protect it from government intervention?
Well, that's a couple of questions. Yeah, I would just say government confiscation, as we had in the 1930s, would be pretty hard to imagine, because it would take a coordinated effort by all governments. Gold is held not just in the United States, but in China, every country in the world, there's gold. So I think it's hard to see a repeat of that 1930s scenario. As far as mutual funds, ETFs, equity ETFs, and gold-backed ETFs, again, I would say higher returns should be expected from investing in an equity-oriented mutual fund or ETF than the gold itself, because typically, and as we've said a couple of times during this presentation, in an upcycle for gold, one could realistically expect 3 to 5 times the performance in shares that the metal would give you, and the metal would be more of a safe asset. I would think of gold mining stocks as being more of an aggressive, higher octane approach to express this macro point of view that we've talked about.
Thank you. All right, the next question is, let's see, apologies as we're getting more and more questions here, and I appreciate all those questions that have come through so far during registration. The next question reads, what is the best way to own gold, and do investors have to pay sales tax when they buy gold coins or bars?
I haven't bought any gold coins in a while. I've forgotten whether they charge sales tax. There typically is a markup depending on what form you're buying it in. So honestly don't know the answer to that question. John, do you?
I don't either. It might be a state-by-state thing. I just don't know. I don't know. But for sure, if you're buying coins, you're going to pay a markup just for the minting of the coin. And then, I think in the current environment, I think there is some price gouging by dealers. So I'd be very careful about that.
Thank you. Gold is often viewed as a hedge against inflation and crisis. It seems the time for gold was moving down as people were raising cash. Is this accurate?
I think we addressed that earlier. Yes, for very short periods of time. When people are strapped for cash and there's a global margin call going on, pretty much everything gets liquidated. Correlations are, 1, inclusive of gold. It does seem to be, though, the first asset that recovers once the liquidity crisis is passed.
And the next question reads, what is the easiest yet intelligent way to explain to clients that silver is not a poor man's way to invest in gold?
Silver has got 2 roles. It's an industrial metal and it's a precious metal. And it's a byproduct of producing other metals 75% of the time. So if demand changes dramatically to the upside, you don't have a supply response. You can't mine more copper and nickel, to get the required amount of silver. As a result, it tends to be much more volatile than gold. It tends to follow gold with a lag. And if one is optimistic about further increases in the gold price, silver will have a long way to go to catch up. And again, as an industrial commodity, nobody necessarily needs to use a lot of it, but it's vital to many products, including iPhones and solar panels and even medical uses. So it's a very, very interesting material, in its own right, but it does differ with gold because sometimes it's a precious metal, sometimes it acts like an industrial metal.
Thank you. The next question reads, is the decline of the dollar or rising inflation numbers more important to rising gold over the next year?
I would say on that, I mean, I hear this a lot. People talk about, you know, a weak dollar is good for gold, but if you think about it, gold has outperformed every asset since 2000. So, and it's priced in U.S. dollars. So by definition, a weak dollar or a strong dollar hasn't mattered at all. I do think it's worth thinking about whether the dollar can maintain its exclusive status as a reserve currency for the world. And that could be a game changer for gold in various ways. It's hard to predict that. It's hard to know when something like that would happen. But as far as looking at the dollar versus the euro versus the yen or any other currency, it really hasn't made any difference at all. And in fact, gold is trading at all-time highs in every currency except the U.S. dollar, and we expect that to change for the better in the next year or so.
Thank you. And the question reads, when will the money fall relative to other major currencies, as I'm sure you agree with a major catalyst of gold's move significantly higher?
I think it's very difficult to predict where the dollar is going versus other currencies. It's somewhat easier for us to pick that all the currencies are going to go down relative to gold.
Great, thank you. And the next question, in the Sprott Physical Gold Trust, PHYS, how or what is Sprott's policy to buy more physical bullion to back new share owners? And the second question to that, and how do you source additional bullion if the event demand outspaces the supply you have sourced?
Okay, on that, we have an at-the-market program that allows us to issue new shares when they're at a premium for our physical trusts. But we don't build up cash doing that. We match off, our purchases of physical gold with the daily activity that goes on the days that we are trading at a premium. In less robust periods, with the trust traded at a discount, there has been an arbitrage mechanism whereby the shares are removed through the purchase of discounted shares offset by the physical and delivering into that. So it's not exactly like an ETF, but it functions somewhat the same. And so we're not issuing shares where we can't source metal, and we're not buying metal that we don't have shares for.
An advisor wanted to know where you see the price of an ounce of gold being 12 months from now.
I've learned after 50 years in this business never to give a price and a date in the same sentence. However, I would suggest it should be higher and possibly by quite a lot.
And another question, is gold a good investment even if inflation does not go up? Is gold more correlated to dollar than inflation? And is gold simply a hedge during the bear markets to park cash safely?
I don't think it's something that people should buy and sell to time markets, because I don't believe it's possible to really time markets. So, my use for gold is, as part of an ongoing portfolio that gets rebalanced periodically. The gold that I own today is going to buy me a lot more shares of, in the S&P the next time I rebalance.
Thank you. And it looks like we have time for just a couple more questions here. And again, if any question that was not answered on today's webcast, a member of the Sprott Asset Management team will reach out to you directly. So the next question reads, do you have a metals fund in a mutual fund, 40 Act mutual fund structure? If not, a recommendation for one?
I think we have our precious metals funds, and they're structured as trusts under the 40 Act. I think Ed is the Sprott Gold Equity Fund has 15% of its assets in gold. That's a mutual fund under the 40 Act. And I think Ed Coyne and his team can be very helpful in terms of getting deeper into individual products.
Great, thank you. And it looks like we have time for one more question. So the final question reads, I have a client whose capacity to add gold exposure is only about 1 to 2% of their portfolio. What gold-related investment vehicle or vehicles would maximize their diversification / potential return for gold?
John?
Yeah, I would just say equities would maximize potential return. Again, I would say every individual client has different objectives, different needs, different risk preferences and tolerances, and I think it's very hard to answer that question in general terms. But again, Ed and his team can probably deal with that on a very specific basis in a follow-up session.
Great, thank you. And with that, I'd like to go ahead and wrap up today's presentation. Again, this will be available for replay, and all registrants will receive that replay information by email. Once again, if your question was not answered on today's webcast, a member of the Sprott Asset Management team will reach out to you directly. I want to thank everyone for their time today and hope you all have a great rest of your day.